In today's session, we will be discussing the definition of accounting. Accounts is defined as the art and the science of recording, classifying, and summarizing transactions in a business. We already know what is meant by transaction. We've seen that transaction refers to the exchange of goods and services in return for money or money's worth. So that is what is referred to as a transaction. Now we're trying to understand what is accounts. So accounts is defined to be the art and the science of recording, classifying, and summarizing transactions. Okay? So there are three activities that you'll be carrying out. You'll be recording, you'll be classifying, you'll be summarizing. Okay? So accounts is this art and it is a science. Why do we say accounts is an art? The moment we talk about art, probably the thoughts or the ideas that will be running through our mind would be famous personalities like Michelangelo or Leonardo da Vinci or Raphael, who are very famous for their art and sculpture works. Okay. The unique aspect about their works is that the presentation of their works, okay, that is amazing or that is beautiful. So that is why we say that art is all about presentation. So just like art is all about presentation, in accounts presentation does matter. So for example, when you prepare a balance sheet, when you prepare the balance sheet, all the assets have to be recorded on a specific side. All the liabilities has to be recorded on a specific side. Okay, that's because presentation matters in accounts. How you present your accounting information, that is very vital in accounts. Next point is that accounts is said to be a science. What is unique about science? Science is all about definite laws. Science is all about definite principles. Okay, science is all about definite laws. Science is all about definite principles. So in science, we have well-defined laws. We have well-defined principles. So, for example, if I pick up an item, if I pick up an object, if I leave it, the object will fall. Why does the object fall? The object falls because of the law of gravity. It falls because of the law of gravity. Now, anywhere in this world, if I pick up an item, if I drop, it will definitely fall. Why? Because the law of gravity is universal. Similarly, in accounts, accounts is governed by laws and principles which are universal. Okay? These are irrespective of whichever country you go, irrespective of whichever nation that you go, the laws, the principles of accounting will remain standard. It will remain fixed. Okay? So that's the reason why we say accounts is a science. So probably in our earlier classes, we must have studied about Newton's first law of motion, Newton's second law of motion, or we must have learned about Dalton's laws of chemistry. So the reason why we've learned all this is because these are definite laws and they're universal in nature. Similarly, in accounts as well, there are a lot of laws, there are a lot of principles, and they're universal in nature. Okay? So accounts is the art and the science of recording, classifying, and then summarizing transactions in a business. Okay, so there are three aspects: recording, classifying, summarizing transactions in business. Okay? So this, in a simple term, this is a simple definition of accounts. Now moving on, let's talk about some complex definitions of account. Account is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. Okay, so this is the standard definition given by American Institute of Certified Public Accountants. So what they've told is that accounts is the art of recording, classifying, summarizing in a significant manner in terms of money, transaction, events which are in part at least of financial character and interpreting the results thereafter. Another definition of accounting is that the process of identifying, measuring, and communicating economic information to permit informed judgments and decision by users of accounting. So this is given by the American Accounting Association. So this is a very intense and it's a very broad definition of account. So it covers the processes which are associated with identifying, which are associated with measuring, which are associated with communication of economic information to permit informed judgments and decisions by the users of information. So that is what you call as accounting. Moving forth, why does a business need accounting? What are the objectives of accounting? Why does a business really need to have accounting? Why does a business must have a separate department which is called as the accounts department? I will be covering three major objectives right now. The first objective is systematic record of transaction. So as and when transactions take place in a business, we have to keep a record. Okay, we have to keep a record of the transaction. Okay, we will have to keep a record of the transaction. So that is, someone has to do this. Okay? Someone has to do this. So for example, when we were studying in schools earlier, or when we started studying in college, as in when the examination takes place, someone keeps a record of how much marks we got. Someone keeps a record of how much of marks did we get for internal, how much of mark we got for the end semester exam, how much of mark did we get for this subject, how much of mark we got for that subject. Now, why is a school or why is the institution doing this? They're doing this because someone has to keep a systematic record of the transactions. Okay, someone has to keep a record of the transactions that has been carried out. Okay, someone has to keep a record of the transactions which have been carried out. So this systematic record of transactions is one of the reasons why you would be needing accounts in a firm. Okay, so a business would be carrying out n number of transactions. So for example, IRCTC. Okay, we've all heard about the website which is called as IRCTC. IRCTC is a website that we will be using for booking a train tickets. IRCTC on an average every day clocks around 25 lakh ticket bookings. Okay? 25 lakh ticket bookings. So that's a lot of transactions. Someone has to keep a record of all these transactions. So the responsibility of accounting is that to keep a systematic record of these transactions. Okay? Someone has to keep a systematic record of these transactions. Moving on, the second reason why we would need accounts is we have to determine the profitability. Earlier, we spoke about incomes, we spoke about expenses. We saw that income refers to the revenue, expenses refers to the outflow of money. So the differences between these two, it will help us to understand the profitability of a firm. It will help us to understand, is the business making money or is the business running on loss? The comparison between the income and expense will help us to understand the profitability of the firm. So this comparison between the income and expense is again done by the accountant. So the accountant will compare how much of income does a firm have and how much of expense does a firm have. So based on this comparison, we will come to know, is the company running on profit or is the company running on loss? So this comparison is referred to as profitability, determination of profitability of the firm. Next is determining the financial position. So what is meant by financial position? We know that assets are resources and liabilities are obligations. So comparison between these assets and liabilities will help you to understand the financial position of the firm. So what is financial position? The comparison between how much of assets you have, how much of liabilities you have. Okay, so this is referred to as the financial position of a firm. So this comparison between between the assets and the liability, it will help you to estimate the financial position. Do you have more assets or do you have more obligations? Do you have more resources? Do you have more obligations? So this comparison is referred to as financial position. So someone has to compare this. Someone has to know or someone has to evaluate how much of assets you have, how much of liabilities you have. This is again done by the accounts department. Okay, this is again done by the accounts department. Okay, so three reasons why a business needs accounting: systematic record of transaction, determine the profitability. We determine profitability by comparing the income and expenses of the firm. Determine financial position. How do you determine the financial position? We determine the financial position by comparing the assets and the liabilities of the firm. So those are the objectives of the business. Let's talk about the history of accounting. Now, the traces of history of accounting dates all the way back to the Mesopotamian civilization. We know the early human civilizations. We know there were four major civilizations: Mesopotamian civilization, Harappan or the Indus Valley civilization, Chinese civilization, and the Egyptian civilization. Now, the traces of these accounting practices, it would date all the way back to the Mesopotamian civilization, 7,000 years back. So accounts is not relatively a very new subject. It is very old. Okay? It is very, very old, and the traces of accounting, it dates all the way back to Mesopotamian civilization. So the practice of bookkeeping, there are early indications, there are early records which show that these civilizations did practice primitive forms of bookkeeping. Then in India, Chanakya had written a book which is called as Arthashastra. Chanakya had written a book which is referred to as Arthashastra. We all know Chanakya. Chanakya was the advisor to Chandragupta Maurya, the founder of the Mauryan dynasty. Okay, so Chandragupta Maurya, he was a shrewd aristocrat, he was a shrewd king, and Chanakya was his advisor. So Chanakya had brought in a lot of policies to streamline the government administration back then. So one of the famous books that he had written was referred to as the Arthashastra. Okay, one of the famous books that he had written back then that was referred to as the Arthashastra. So Arthashastra, it talks about, it gives details as to how the government can go about with bookkeeping. Okay, how the government can go about with the bookkeeping. Now, one of the empires which was responsible for formally bringing in organized administration systems were the Romans. Okay? So Romans were responsible for bringing in organized systems of administration. So they had given way to audit systems. Okay? Or they had given rise to audit systems. So Romans had developed audit systems where they would go back, they would cross-check the records which has been evolved, which has been maintained. Now, following this, there has not been much major developments in the stream of accounting until it was Renaissance in the Europe. Okay, until it was Renaissance in the Europe, there were no major developments to the area of accounting. During the course of Renaissance, a famous Italian mathematician and a priest, he was a priest by profession, his name is Luca Pacioli. He wrote a work which is called as Summa de Mathematica, in which he had given the outline for double system of accounting. Okay? So he had spoken about how a business should be maintaining books of accounts, especially under double entry system of accounting. So that's the reason why Luca Pacioli is often referred to as the father of accounting or father of bookkeeping. Okay? So Luca Pacioli is referred to as the father of accounting or father of bookkeeping. Okay? Now, following the Renaissance gave way immediately to the Industrial Revolution. Renaissance immediately gave way to the Industrial Revolution. So with the Industrial Revolution coming into picture, businesses became highly organized, businesses became highly structured. Okay? Businesses became highly organized and businesses became highly structured. With businesses becoming highly structured, what happened was there was more need to keep a track of the transactions which has been carried out. That is how accounts eventually grew into what we know as today. Okay, so accounts eventually grew and it became what it is today. Okay, so from there, it has evolved into a subject that today we study in the classroom. So this is a brief outline about the history of accounts. Okay, so accounts is a very old subject, and it is as old as the early civilizations, and the major breakthrough came with Renaissance, and then following Industrial Revolution, it gave rise to the need for formal systems of accounting. There are three major branches of accounting. Okay? There are three major branches of accounting. The three major branches of accounting are financial accounting, cost accounting, and management accounting. Now let's understand what these branches of accounting specifically are for. The first branch of accounting that we are going to be talking about is financial accounting. Financial accounting is the branch of accounting that deals with preparation of books of accounts. They deal with preparation of books of accounts. They're responsible for preparing journals. They're responsible for preparing ledgers. They're also responsible for preparing final accounts. So the job of a financial accountant is to ensure, as and when transactions are taking place in the business, that simultaneously journals, ledgers, final accounts, etc., all that is getting updated. All that is getting updated. All the records have been systematically maintained into these books of accounts. Now here, you must be familiar with the category of people who are referred to as chartered accountants. You must be familiar, or you must be aware of the category of people who are referred to as chartered accountant. Who is a chartered accountant? Chartered accountant is an accountant who specializes in the system of bookkeeping. Okay? So chartered accountant is a accountant, or is a specialist who focuses on the preparation of books of accounts. Okay? So that is what a chartered accountant does. So, for example, if you aspire to be a chartered accountant, you will have to take up the examinations with the Institute of Chartered Accountants of India. But by doing so, what exactly are you focusing on? You're focusing on how books of accounts can be maintained in a business and how final accounts can be prepared in a business. So, this is what you will be focusing on. The second branch of accounting is cost accounting. So, cost accounting, what they do is they would analyze the books of accounts, they would study cost. So, they are interested only in the cost information. Okay? They would see how much of money was spent for material, how much of money was spent for labor, how much of money was spent for taking a loan, how much of money was spent for transportation. So, they would focus only on information specific to cost. Following this, they will devise methods to reduce cost. They will come up with strategies, they will come up with techniques, they will come up with methods by which this cost can be reduced. So that is what a cost accountant does. So cost accountant uses accounting information. From the accounting information that is available with him, what he would be doing is he would be studying the cost, and he would be coming up with strategies, methods to reduce cost. The third branch of accounting is management accounting. Now, what is management accounting? Management accounting, they use accounting information to take meaningful business decisions. Okay? They use accounting information to take meaningful business decisions. Okay, so what they would be doing is they would be depending on accounting information, and then what they would be doing is they would be thinking of methods to reduce cost. Okay, they would be thinking of methods to, or they would be helping the business to take good decisions. So, for example, let's say if you want to, if you, let's say, Reliance has decided to acquire Big Bazaar, future retail. So it's a big decision, right? So is the decision correct or not? So that kind of an analysis is done by the management accountant. So management accountant will be analyzing all the books of accounts. They will be looking through the books of accounts, and they will be giving sound advices to the management, letting them know are they taking good decisions or not. So by carrying or studying courses such as CIMA, basically you'll be specializing on becoming management accountant. So there are three branches of accounting: financial accounting, cost accounting, and then management accounting. Three branches of accounting, and first branch of accounting, you're focusing on preparation of books of accounts, and then methods to, and then preparation of final accounts. Cost accounting, you are dealing with the study of cost and then methods to reduce that cost. Management accounting, you're dealing with using accounting information to take good business decisions. So these are the three major branches of accounting. Now, moving on, next topic that we will be discussing is the relationship between the three branches of accounting. Okay, here we will be focusing on how are these three branches of accounting interrelated. It all starts with transaction. We know that transaction is the exchange of goods and services between the buyer and the seller. So as soon as a transaction takes place between the buyer and the seller, the financial accounting division is responsible for maintaining the books of accounts. So as soon as the transaction takes place, the transaction has taken place, immediately the financial accountant will prepare the journals, post the transactions into the corresponding ledgers. So that is the responsibility of the financial accountant. Next is cost accounting. So depending on the records which are maintained by the financial accountant, what the cost accountant will be doing is, cost accountant will be keeping a record, will be analyzing the details, and he will be categorizing the transactions based on the cost. Okay, so if it's material, he will put it in a different category. If it's labor, he will put it in a different category. So depending on what cost it is, he will go about segregating the cost. Okay, he will go about segregating the cost. Then the management accountant will come into picture. So what the management accountant will do is, he will take inputs from the financial accountant as well as the cost accountant. So financial accountant will take inputs from, management accountant will take inputs from financial accountant as well as cost accountant. So based on the inputs that he's receiving, he will analyze the information He will analyze the details and he will give suggestions to the management. He will give suggestions to the management. Then the management, based on these inputs, they will be taking the decisions. Now, one more thing that you can notice is based on the cost accountant's analysis. Okay, so he's found out that the business is spending too much of money on material. So he can give that input to the management. So what management immediately will do is they will translate that into a decision. Immediately what they will do is they will translate that into a decision. So based on the inputs provided by the cost accountant and the management accountant, decisions have been taken, and then based on the decisions which are taken, this in turn will translate to transactions. This in turn will translate to transactions. Okay, so here, what will happen is cost accountant is taking, he is analyzing the cost. Management accountant is analyzing the business information. Based on these details, the details are being provided, and then management is taking decisions, and these decisions would in turn translate to new transactions. So, for example, you're a business, you had presence only in Bangalore. You decide to expand to Delhi. You decide to start a new branch in Delhi. So when you start a new branch in Delhi, you will have to buy land, you will have to buy machinery, you have to buy office equipment, you have to hire new staff. So all that is new transaction. So new transaction they are taking place. As soon as the transaction takes place, again the cycle kicks in. Financial accountant records the transaction, pass on the detail to cost accountant, management accountant. They will evaluate, give inputs to management. Management will again take decisions and moves on. Okay? This is how the three branches of accounting are interrelated. Okay? So this is how the three branches of accounting, it is interrelated. Next, we will be talking about the users of accounting information. Okay. Next, we will be talking about users of accounting information. There are two broad categories of accounting, users of accounting information in an organization. Internal users, external users. There are two broad categories of people who would be needing to use accounting information. They are internal users, they are external users. Who are internal users? Internal users are users who are located within the organization. They are people who are present within the organization. Okay? They are referred to as internal users. Okay? So people who are located within the organization, they are referred to as internal users. The second category of people who would be needing, they are referred to as external users. External users are people who are located outside the organization. Now, how are internal users different from the external users? Internal users, they will have access to extensive information. They will have access to a lot of information. Okay? Because they are located within the organization, they will have access to extensive information. They would be needing a lot of information. Okay, so that is referred to as internal users. So some of the people, some of the examples of internal users are employees, directors, top management, senior management. So these are some categories, or these are some examples of internal users. Now you have external users. Who are external users? External users are people who are located outside the business. They are not within the purview of the business. They are located outside the business. Now, since they are people who are dependent on outside the business, what will happen is they will have to rely on the internal users if they want to get any details. Okay? If they want to get any details, they will have to depend on the external, they will have to depend on the internal users. Now, because they're depending on the internal users, they have access to limited information. They have access to limited information. So some examples are government, creditors, etc. These are some examples of external users because they are people located outside the business and they have access to only limited information. So these are the two major categories of accounting users that you will find in an organization. Now we will be talking about the limitations of accounting. What are the drawbacks of accounting? Now, the first drawback that I want to discuss with you is accounts. In accounts, we are interested only in monetary transactions which can be expressed in terms of money. We are interested in only those transactions. If a transaction cannot be expressed in terms of money, we are not interested in it. It is not of importance to us. It is not of significance to us. Second drawback is it is historical in nature. So for an accountant to come into picture, the transaction must take place at first. So only if the transaction takes place, then the accountant will be able to come into picture, and then he will be able to take over, he will be able to analyze, he will be able to evaluate, and then he will be able to share it. So accounting as a subject, it is historical in nature. It is historical in nature. Now, there are no global policies when it comes to accounts. There are no fixed practices. There are no fixed policies. Every country, the accounting practices might vary. For example, the financial year. In India, financial year is from 1st of April to 31st March. In India, the financial year is from 1st of April to 31st March. Whereas in USA, the financial year is from 1st of Jan to 31st March. Sorry, 31st December. 1st of Jan to 31st December. In Nepal, the financial year is from 16th July to 15th July. 16th July to 15th July. Every country is having their own accounting. Every country is having their own financial year. So there are no global practices, there are no policies in place. So sometimes what happens is the treatment of transactions, it could vary from country to country. It could vary from country to country. So that's a limitation. Next limitation is there is very less scope for future assessment. For you to predict how transactions will turn out to be in the future, the scope in accounts is very less. So for example, probably one of your marks, one of your students, one of you in the class, if I evaluate your marks for last maybe last 12 years of your academic cycle, I will be more or less able to predict how likely you will be doing in your degree. Okay, will you be scoring good marks? Will you be scoring average marks? Okay, because there is a scope for future prediction. But in accounts, it is not like that. How, irrespective of how much ever past information that you analyze, it will be very difficult for you to make a prediction for the future. So that's a major limitation. Next thing is, for you to carry out accounting in your business, okay, for you to carry out accounting in a business, you would be requiring a qualified professional. You would be needing someone who is an expert, someone who has learned accounts, someone who knows accounts. Only then you will be able to carry out, or you will be able to carry out accounts in your firm. You'll be able to carry out accounts and the activities of accounts in your business. So these are 5 major limitations of accounting. Next, I will be talking to you about accounting systems. Before I talk to you about accounting systems, I have to explain the concept of effects of transaction. Please remember, every transaction that takes place in a business, there is always 2 effects which are associated with it. We say one effect is a debit effect, second effect is a credit effect. Let me explain this with a simple example. Imagine back at home, daddy decides to sell the car. So the transaction is selling the car. The moment daddy sells the car, daddy will no longer have the car. Until such time daddy owned the car was a resource for the daddy. It was something that he was using. It was something that he was utilizing. But the moment the car gets sold, daddy is no longer having a resource. So the first effect is that the car has gone out. You no longer have a car at home. So that's the first effect. Second effect is that the moment daddy sells the car, he will be getting some money. So he's given up the resource, in turn he's got some money in return. Okay? So first effect was resource has gone out. Second effect is that daddy has got the let's talk about another transaction. Here, imagine mommy goes to the jewelry shop and decides to buy some jewelry. So the transaction is purchase of jewelry. Okay, so the transaction over here is purchase of jewelry. So daddy and mommy go to the jewelry shop. Mommy looks to the beautiful designs, and mommy finds out some design that she's really fascinated about. She picks it up. Now, what daddy would be doing is daddy would be making the payment. The transaction was purchase of jewelry. Let's look at the 2 effects. The first effect is daddy had to pay money. So for daddy, money is going out. The second effect is that mummy has got new jewelry. One transaction, two effects. So any transaction that you look in a business, there are always two effects. Imagine buying land for your business. You're paying money, you're getting the land. Imagine selling some machinery in your business. You're giving up machinery, you're getting money in return. So every transaction in a business, there are always two effects which are associated. Now let's talk about the accounting systems. There are two types of accounting systems: single entry system, double entry system. How are these systems different from each other? In single entry system, when a transaction takes place, you will be recognizing only one effect of the transaction. Remember, every transaction has got two effects, but in single entry system, what happens is you're recognizing only one effect of that transaction. Next is double entry system. In double entry system, what happens is you are recognizing both the effects of the transaction. There are two effects, both the effects of the transaction you are recognizing. Okay? Both the effects of the transaction are being recognized when it comes to double entry system. Single entry system, it is said to be unscientific system of accounting. Why? Because you are recognizing only one effect. It is incomplete. It is not comprehensive. It is not complete in nature. That is the reason why we say it is unscientific. Double entry system, it is said to be scientific system because both the effects are recognized. Okay, both the transactions are taken into consideration. Next is incomplete system of accounting. We say that accounting system, it is incomplete system of accounting because you're recognizing only one effect of the transaction. Double entry, you're recognizing both effects. That's the reason why we say it is complete system of accounting. Then single entry system, it is usually used by small time companies, small time firms, probably your neighborhood grocery seller or your neighborhood mechanic. These are the categories of people who will be using single entry system. Double entry system, any well-established system business, they will have to follow double entry system. For example, back at home, if you have a habit of recording your pocket money, okay, so daddy gave you so much of pocket money. Day one you spent for food, day two you spent for mobile recharge, day three you spent for this. What is that? That is you're keeping a record of your pocket money transactions. That is an example of single entry system. Now, in single entry system, for you to maintain your books of accounts according to single entry system, you do not need a qualified or a dedicated resource. Anyone can do it. Whereas to keep your books of accounts according to double entry system, you need someone who's well versed with accounts. You need someone who is familiar with accounts, who knows how to keep a record of the transactions as per the double entry system. Okay? So these are the differences between single entry and double entry system. So please remember, single entry, only one effect of the transaction get recognized. Double entry, both the effects of the transactions are getting